Hey everyone, it's Peter from Argo. We just put out an RNS this morning about a number of actions that we're taking to strengthen our balance sheet. And there's a lot in the RNS, so I wanted to walk you through it. Obviously, those of you that follow the company have heard me do this before. And so I'm just going to kind of walk you through the actions that we're taking and how we're trying to position the company given the bear market conditions that are out there right now for cryptocurrency miners. And really for public markets in general. So just to kind of recap the situation, obviously Bitcoin's been trading around 20,000 for the last few months. And at the same time, electricity prices have gone up significantly. I've discussed this in my last video update, and the big driver of this has been the price of natural gas. When we energized our Helios facility in May, energy prices had already gone up. It wasn't a good time at that point to sign a long-term PPA. So we've been using spot price PPAs, which has exposed us to higher electricity prices. Our mining margins have been compressed. The first half of the year, they were, roughly 71%. The second half, they've been, they've dropped significantly, 37% in July, 20% in August. So our profitability has been squeezed from both sides, from higher energy prices, from lower Bitcoin prices. And that's resulted in a bit of a cash crunch for Argo. Our board of directors has made the decision to take a couple actions. These actions, once we're fully implemented, will improve our financial position, put us in a good place to have enough liquidity for the next 12 months. And this shouldn't come as a huge surprise. Again, if you follow the company closely, I've said, that we needed to raise money in the second half of this year. And with equity markets, being challenged, with debt markets being very, very closed or very tight, almost closed, the options for miners these days are not that significant. So we feel like we found two really good options, and I'm going to walk you through what those two options are. So the first action we're taking is to amend our loan agreements with NYDIG, who's our primary lender. We have about 84 million in loans outstanding with NYDIG. And as part of the amendments that we're doing, we're going to unlock about $6 million of cash that was previously restricted in a reserve account with NYDIG. Getting access to this cash, again, helps our liquidity. On top of that, we are revising the amortization schedule for the NYDIG loans, and that reduces our monthly payment obligation and improves our cash flow. And that's a significant improvement for us. Obviously, our loans are the largest portion of our loans are backed by machines. And so the debt service payments is going to be linked much closer to hash price, which essentially measures the overall network mining profitability. So instead of just having a lump, a payment every month that is predictable, which can be a burden when profitability goes down, the payment that we're making to NYDIG for the machine financing is linked to how profitable mining is. So a much better situation for the company. It allows us to pay back the loans faster if Bitcoin goes up, but it also provides us with downside protection if the price of Bitcoin goes down. We've also announced a sale of 3,400 of our S19J Pros to a third party, and then they will host them with us at our Helios facility. This will generate just under 7 million in cash proceeds, or roughly 6 million pounds. We will also have a profit sharing agreement with those machines at Helios. Again, that's roughly 10% of the machines at Helios, and again, helps with our liquidity in the short term. It does impact our hash rate guidance. Obviously, we have less machines in our fleet, and we our most recent guidance that we put out at our Q2 earnings call. So we're going to go down from 3.2 to 2.9, and that's our total hash rate capacity that we expect to achieve by the end of this month. Finally, we also announced a really exciting, what I think is an exciting subscription agreement for common shares with a strategic investor. And this will raise approximately $27 million or about 34 million pounds of cash. In order to complete this deal, it's going to take about 30 days of due diligence. We are issuing about 87 million shares to this investor, and they'll own just about 15% of the company when the deal closes. Obviously, we've talked a lot about when's the right time to do an equity raise, and the board really took into consideration whether now was a good time. And we know that there's going to be some folks out there who are going to be upset because there's dilution. And the deal, was done at a roughly 20% discount. But this is a really important strategic investor. It's not fast money. It's not a hedge fund. And we're going to, have them on the board. They're going to be part of our long-term vision for the company. And so we feel like it was necessary to get, more cash in the door in the medium term for us, to be able to really position ourselves well for the next 12 months. And, we've been through bear markets before at Argo, and really the name of the game is survival and making sure that you are able to take advantage of the bull market when it comes on the other side. And in order to do that, you need to, make some hard decisions. And so we've made some hard decisions around raising equity, but we think it's with a really good investor that who's going to be, who we believe is going to be around for the long term. So, just to kind of wrap up, we've gone through some interesting times in the last few weeks. I think you can hear it in my voice. The team has been working really hard to try to kind of find a solution for both the short term and the medium term. We think we've done that, and the long term. We think we've done that, between the amendment to the NYDIG loans, the sale of the machines, the subscription of shares. We're going to bring in about $40 million in the next, little while, and that will significantly improve our financial position. So assuming all of these transactions close as agreed upon in the LOIs, we're confident that we have the liquidity and the balance sheet necessary to get us through the next 12 months. Moving into the very near term, our primary focus is to secure a PPA. Obviously, the power prices in Texas, the high power prices in Texas this summer really hurt us. And we're now in a better position with this improved cash position to secure a long-term PPA. And when we do that, this will stabilize our power costs, allow us to generate more consistent cash flow, and will really help the business in the long term. All right. Thanks everyone for watching. Appreciate your support. Onwards and upwards.